Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. It is Wednesday, and we are back with our longest running guest, Anna Kelly. How you doing, Anna?
I'm doing great today. So good to be here.
Absolutely. So thank you for doing this every week with us. It's been almost 2.5 years. Anna, if you don't know, has a playlist on this channel, I would guess with 200 hours of content, talking about what we are doing in our business, economy, our stories. You could really binge watch Anna Kelly for a couple of days and learn something every time with every topic. So thank you so much, Anna.
Thank you so much. I appreciate that.
So one thing we're going to talk about today is, it's funny, on Monday morning during my daily financial news, I called that I think the Fed's going to go 50 basis points in May and 50 basis points in June. I was out early, and lo and behold, 2 days later, Goldman Sachs came out and basically said the same thing. So I'm glad that Goldman's watching my channel and getting content.
Absolutely. And remember, I said it was going to go up 50 basis points. Yep. But you were right that Powell wouldn't have the guts to do it initially. Yeah. He should, as we said, and he will, just not the first time out. It would create too much panic. Yeah, it would say, we don't have control. Now they're saying, give us control. We'll slowly but surely get there, right?
Yeah, again, and Powell is I'm more convinced than ever that Powell wants to tell the market what's coming. And he told them that a quarter was coming, so he gave him a quarter. He came out, I think it was Monday, and basically said, we have one mandate, no longer full employment. It's done. It's stable prices, and get ready. Yes. And he never said half a point, although he said it's certainly possible. But the market now he thinks the Fed funds rate is going to go up 100 basis points inside the next 6 to 7 weeks. And what I want to do with you is I want to look a little bit farther ahead. And I think there is no question that sometime in the next 16 months, the Fed funds rate, the front end of the curve, the most front end of front end, will be 3%. And you know what that means to the 2-year, the 10-year, and 30-year. But more importantly, I want to talk about what happens in the economy, what happens in the commercial segment, what happens in residential. As simply said, risk reprices. What do you think?
Absolutely, 100%. And it is sending shockwaves even to the stock market, and because they know that money has been so cheap for a long time, since at least 2008, right? 2009. So we've essentially had 14 to 15 years of extremely low interest rates. And everything that's been bought during that time, Michael, has been bought with very, very cheap debt, resulting in extremely high leverage and very high risk compared to years before, right? Yep. And so the stock market understands that when rates go up, when the Fed rates go up, even 2 or 3%, which doesn't sound like a lot, right? But debt on all the things they purchased gets more expensive because it's all variable rate loans. And most corporations, what a lot of people don't know, and big multifamily investors, commercial real estate investors, continually roll loans, right? Unless they're selling properties, they just keep rolling over their loans. And so they're borrowing at cheap debt, and that's allowing them to make strong leveraged returns. When that stops, the frenzy stops, the music stops, and values start to come down. Companies have to start selling in order to liquidate the debt and not increase their debt payments. And oh, by the way, when you have inflation at the same time and everything's more expensive, the years of heavy growth are gone. And it's why the stock market's rumbling. The other quick thing, and I know there's a ton to unpack, we could talk about this for weeks, right? But the other thing that I'm really looking at, Michael, when this starts to happen is a lot of the investments that we've seen go up significantly in value, including commercial real estate, because that's where I live a lot of my time, right? Have gone up because investors are incentivized to take risk to get any return, and any return that beats inflation. Well, when the Fed's rate is 0, 0.25%, investors and companies that used to save money to make an average of 5% over decades and decades would just invest in treasuries, no risk. They'd make 5. Inflation was 2. They made 3 on the spread with no risk, right? No risk, yep. But what's happened is the Fed has kept rates so low, and given so much free money for a long time through quantitative easing and loan programs, all investors have been incentivized to take a lot more risk just to make 3 or 4%. And when rates go up, all of those things that were risky, making us 3, 4%, 5% on a cap rate basis, they go down in value. So this is a real problem that a lot of people don't understand, how bad a huge rate hike could rock the financial system, but yet inflation could make it worse. So they've got to tackle both of those things. What's worse, inflation or crashing the economy built up on these low rates? And they're showing that inflation's so bad, they know they're about to crash the economy. So to your point about Powell, he's giving warning signs and has been to go, get ready, get liquid, sell stuff, get ready, because we're about to have to really raise rates in the party in order to keep inflation down.
Yeah, there's so much here. We may tackle this again, and probably will be tackling this for months to come. But
yeah,
when I break down what's going to happen, I want to talk about 3 sectors of the economy. First, we'll go to commercial. That's where you live. And I see this rate cycle being probably 2 to 3 years in the making. I think he's going to do a lot quickly, but then he's not going to be done, right? He's not going to be done with 250 basis point raises. And as you said, a lot of these commercial syndications, man, if you did a bridge loan in the last year and that comes up here in the near future, I think there's a lot of commercial, and I'll just call them syndications for lack of bundles, whatever you want to call that, investors, they're going to be in real trouble.
Michael, I've been warning a lot of my colleagues for the last year and a half. I mean, we knew recession might come before the pandemic, and that kind of kicked us over the edge. But ever since then, it's like there is so much risk for very little relative return that it's not worth adding interest rate risk when we know that things cannot continue to go this way. So I've been completely out of bridge debt. I don't do bridge debt anyway. But 90% of syndications, and I'm not kidding when I say at least 90% in the last year, have been done with bridge debt. And I have chosen to stay that party out because of the level of risk. A lot of syndicators are going to be very, very hurt. And this is whether you're in multifamily, retail, industrial, it doesn't matter.
Doesn't matter. Again, I've been screaming this again, the '08 crisis, and Jonathan Twomley and I talk about this a lot.
Yeah.
And I relate my residential with his commercial, and the '08 crash, as you know, being in that space then, it was the debt structure that caused, the pop was prices, but it was the debt structure that kept rolling through as the arms kept resetting. And arms in residential to me is bridge debt in commercial. It's the same thing.
Absolutely. Yes.
Just a different name. And there's going to be a lot of pain. There's a lot of, I said this and I'm going to say it again, a lot of LPs have already lost all their money. They just don't know it yet.
Right. And listen, Jonathan is super smart. I mean, we think a lot of alike, and he's taken some flack that you're just, too curmudgeonly or too, too bearish, too pessimistic. How are you supposed to raise money from investors? Right. And here's the thing. Those that are raising money from investors, and I've syndicated deals very, very carefully and cautiously, right? But it's not popular to tell investors, you need to be careful. I don't want to put you in these investments because things are going to get worse. When 90% of syndicators are going, the party isn't going to stop. We've got all these stopgaps. Now, there are some stopgaps like cap rate, interest rate caps and things like that. But Jonathan and I and you lived through '08, and we saw that those that had short-term loans, mostly property flippers, were those that were killed. And in the commercial world, there's a lot more money, and we want to think we're a lot smarter than that. But the same things that got us into trouble in '07 and the previous years before that came to a head at the end of '08 and '09, we've repeated the same mistakes in commercial real estate. And guess what? Hedge funds and big corporations, pension funds, insurance companies, they've repeated the same mistakes. But instead of buying residential mortgage-backed securities, now they're buying commercial mortgage-backed securities and corporate loan obligation securities that have the same level of risk or more, but at much higher dollars at stake. And I'm real nervous that a coming recession and these big interest rate hikes is really going to make that house of cards fall, and a lot of people are going to get really hurt.
Yeah, there's going to be a lot of stress in the commercial market. A lot of deals with 1 year, 18 months, 2 years bridge debt. It's just going to be bad. But
yeah. And companies are in the same boat, Michael.
That's where I'm going
why
next.
Is the stock market nervous? Companies have done the same thing.
That's exactly where I'm going next. And the economy or companies. There are zombie companies, I don't know a better term for it, that have lived off of debt. They are not making money. They are losing 50, 60 cents, $1, $2, $5 a share. And they're only surviving because their blood or oxygen is debt. Sometimes selling shares, but usually it's debt. And again, in an environment where interest rates are essentially zero for a long, long time, you almost get numb to the fact, and you're willing to make very dumb decisions. You just
Absolutely.
are. You just are.
And Michael, 20% of companies traded on the stock market right now are zombie companies. And when you say this, just to kind of break it down in layman's terms for those of us, for our listeners, these are companies that essentially have chosen to borrow so much money so that they could, prop up the value of their company by making purchases, investments, et cetera, hoping that in the long term, they can really create value and growth for their company and their investors. But rather than making money on their production, which is historically how we make money, right? The earnings over the earnings per share, essentially, the earnings that we generate is how we, go up in value, essentially. They're making money on debt. They're hoping, because rates are so low, they can borrow so much that they don't have to worry about the money coming due, because they've been able to just roll it over and kind of keep refinancing that low rate debt perpetually. They're not making principal payments. They're only making interest payments. And when you call them a zombie, their interest payments are higher than the net earnings that they generate. So they keep borrowing more. And there are bankers and hedge funds that are lending them more, even though they are negative net worth companies, essentially, because they just keep hoping that if they kick it down the can and produce enough, eventually their earnings are going to go up enough to cover the debt. These companies are on the verge. They're already should be in bankruptcy. They have a negative net worth, but 20% of companies just keep getting more essentially free money, and they make their money on manipulating corporate debt, not on the earnings of what they're producing. And that's really scary.
Yeah. And again, I've been in this environment before. I had to make these decisions there. Again, unemployment may stay low for another year. Maybe. Again, I think we have stagflation for 18 months and then a nasty recession for a year. And one of the outcomes of this is going to be higher unemployment, because again, these companies, just like the syndicators that are going to get wiped out because they had bad debt structures, companies that have bad debt structures and don't freaking make any money, they'll disappear. And unfortunately, that means unemployment is going to go up.
Yes.
And then the last sector we're talking about, just because I play here a lot still, is residential.
Yes.
I called it last week that there was this shift. I now believe because of higher gas, higher rates, 4.5% is the average. Yesterday, I checked 4 3/4. Best credit, 20% down, owner occ loans. Oh my God, they are up 200 basis points in 11 weeks. I believe the residential market is about to freeze, lock up. Now, for folks, it's just like a champagne bottle. You shake it up, you let your thumb off, which is what's been happening in the last 60 or 90 days because people on the sidelines are rushing in. You may be in a market that's still in that celebratory, phase, but it will stop. Those people will run out, and we are going to see transactions fall off a cliff. I'm guessing 20 to 25%. We were at a run rate of 6.1. I could easily see it get to 4.8 to 4.5. This is coming in the residential space because it's going so fast. Affordability has to come down, and it's going to wake people up, I think.
Yeah, absolutely. And I like the way that you put that, because it doesn't mean it's a permanent thing, right? It doesn't mean that it's a major real estate crash.
No.
There's a lot of debate over whether residential real estate is going to crash, right? And there's a lot of debate about that. And the reality is nobody really knows, because of all these factors that all are coming to a head at the same time. The low rate debt, The consumer psyche has been used to low rates for 15 years. And that's longer than most homeowners have even been buying houses, to be fair, as
Correct.
millennials and Gen Xers and, even some Gen Zers are starting to, buy homes. So they've only seen low interest rates. And here's the thing, while incomes have gone up, as we've talked about a little over the last couple of years, the reality is over an 11-year period from 2007 to 2018, okay, which wasn't that long ago, wages only went up 0.05%, 0.05%, while inflation has probably been at least 3%, right, based on CPI.
Sure.
So wages are not keeping up with inflation already, although the news media doesn't like to talk about that, right, on an inflation adjusted basis. But the reality is this, as inflation increases and costs go up, and the consumer has seen their mortgage prices double. I have a relative, they're probably middle class, right? Building a new home. When they started their build, they were quoted under 3%. They were like at I read it the other day, maybe 2.5, 2.6%.
Okay.
Literally their interest rate has doubled mid-construction on their home. That means their mortgage payment probably has doubled from what they were quoted, while they have a 10% hit to their expenses. And this is the average American. It shakes people up. My point is all of these things shake people up. We see 2%, people go, what's the big deal? It's still historically low. And it is still historically low over the long time. But the American psyche, who has been hit so hard with the pandemic, lots of job losses. Don't forget that was only a year and a half ago, right? Drained so many of their savings accounts already. And Americans on average only save about $4,000. Then they're worried about fear of job. They're worried about fear of life. Now we've got inflation. Now we've got war. Now affordability is even worse. Rents are up. The American psyche is going to be rocked, Michael, for a little while. So it's not as easy as the numbers. Where's the supply and where's their demand? A lot will argue, and we know that prices are a component of supply and demand, and there's limited housing supply for the demand across the United States. But when the psyche of the buyer and the home buyer is rocked like it is right now, probably worse than we've seen in most of my lifetime,
Agreed.
It's going to slow down home buyers from buying. So it's going to slow down sales, to your point, significantly. The question is, how long does it last? Can the Fed reverse course, or is inflation too bad that we're living with this thing for the next 2 to 3 years? I think there's a huge housing slowdown. What it does to values, I think, is very variable depending on where in the country you are, the median price home in that area, jobs, and all of those kind of things. But people that say this is going to keep rocking because of low supply, the demand is going to be quashed. And I think that there's going to be more pain than a lot of investors want to admit.
Totally agree. Winter is coming, and we will talk about that in the next session as well. Anna, how can people find you?
Great. Every week, every Wednesday, every week, you can find me here on your channel and on my playlist. And you can find me on social media at Anna Kelly, REI Mom, and my website is reimom.com.
Awesome. Thanks, Anna.